Okay, let's take a look at this. And as always, it's always a good idea to start by reading through and make sure you know what the hell you're talking about. So on January, we bought 30%. Okay, that's a good number. Outstanding stock. And our 30% cost us $420 million. At the date of the acquisition, the net assets had a fair value of $800 million. Their book value was $700 million. And the difference was attributable to buildings and land exceeding book value, each accounting for about 1/2 of the difference. Net income for the year was $140 million. 30% of that is ours. They paid cash dividends of $30 million, so 9 of that is ours. And the buildings have 5 years left, so we're going to be able to take some depreciation. So let's go through and scratch out some numbers here and see what we have. So let's see. We bought 30% for $420. So the fair value of the assets was $800,000, and we bought 30% of those. So we bought $240 million worth of assets, and we paid $420 million. It's our purchase price, right? Purchase price $420. Counting one, definition, goodwill, the difference between purchase price and the fair value of the assets. So we have $180 million worth of goodwill here. So that's something we need to know. Let's see. So we got that, we got that, we got that. Their book value and fair value. Okay, so we have some undervalued assets. We have book value of assets of 700, and we have fair value of 800, right? So that from that gives us 100. Okay. So we got 30% of that. So we get, we have 30% of each of these. So 30% of this is what, 210, and 30% of that is 240. So altogether we have $30,000 or $30 million of undervaluation. Because they tell us that it's a difference. Okay, so we got 30% of that. We could have taken the 8, subtracted the 7, and taken 30% of that. Simple fact of the matter is we have $31 million of undervaluation, and we're told that 15 of that is for the buildings and 15 is land. Tell us that. Okay, about half of each. Well, the land we don't depreciate. Goodwill we don't depreciate. But we do have the building here. And the building, they tell us, buildings have a remaining life of 5. So we have $3 million a year in depreciation that we can take. Okay, so that's all the stuff we need to know. So let's go take a look at their chart and see what they want us to fill in. I think we have all the pieces. Okay, the fair value, they got the name wrong, morons. Every time you see car name, you make pretend it says Cameron. So the fair value of the investees' net assets, that's the investee, the company we're buying, is 800. We bought 30%. That gives us $240 million. And the difference is 180. and that is indeed attributable to goodwill. That was that first calculation we did. Then it asks us to look at the book value of the assets, and the book value of the assets was 700, and we own 30% of them, so that's 210. So that difference is 30, and that is due to undervaluation of assets. Now, of that 30, we know that half is building, and that's really the only one we care about because the land doesn't depreciate. So we have half of that, so we have 15. So our depreciation that we can adjust as 15 million, we can take that over 5 years. So our adjustment for each of those 5 years is going to be 3 million. So that's the first thing it asks us to do. Then the next thing it asks us to do is do in part 2. Let me get to part 2. It says, let's do the journal entries. I actually think it tells us to do that in part 1. So let's do the journal entries. We have the stuff here, so let's do it. So investment in the shares, 420,000, or 420 million, excuse me, in cash. And our investment is increased by our share of the income. So how much revenue do they have? They tell us, I forget, where is it? The revenue, the revenue for the year, net income, was 140 million. We have 30% of that 140 million. So 140 million times 30% gives us 42. So we're going to increase our investment by 42 million, and we're going to recognize revenue of 42 million. Now we also get dividends. So they tell us that they declared dividends of how much? 30 million in dividends. 30% of those were ours. So we got the cash. We got 9 million in cash. But that reduces the value of our investment. Okay. We also get to take some of that depreciation. Remember, we get that depreciation adjustment of 3 million. So that will reduce our investment revenue. It's a debit to our revenue, and it will reduce the value of our investment. So now we need to take a look, and it says we have to figure out this part, the investment in the balance sheet, the investment revenue in the income statement, and the investment in the statement of cash flows. So we'll do that piece by piece. As soon as I find my notes, I can actually talk to you about it. So our investment started at that, and then we'll do the T account. That's the easiest way to do this. This is Lake Construction Chairs. So we started out with 42. Okay. 420 million. That was our investment. And then we earned 42 million in our share of the investment, our share of the income, 42 million. That's 30% of the 140. But we reduced that by the $9 million in dividends, and we get to reduce that by the depreciation. So at the end of the year, the value in this account is 450 million. So 450 mil. That's the value that we're going to show for Cameron in the balance sheet. Now, the investment revenue for this company is going to be just this piece. We have our 30% of income, 42 million. We have our 30% of the dividends, 9 million, and we have our depreciation of 3. So our investment revenue in the income statement is going to be 42 minus the 9 minus the 3. So that's going to be our total investment revenue in the income statement, right? Any questions about that? Make sense? Okay. So that's 30. So our investment revenue will be 30. And our investment in the statement of cash flows is going to be the 420 that went out when we purchased them, because the investment revenue comes in as operating and it says investment. So there's a problem.